Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
After listening to today's news, you'll know first, Chinese startup DeepSeek's low-cost AI model wipes $593 billion from Nvidia, challenging Silicon Valley's high-cost dominance. So we'll discuss why this economic efficiency war changes the AI competition and what it means for US tech business models. Second, a Chinese grey market scheme funnels over 700,000 Western cars into Russia, bypassing automaker sanctions. We'll explore how this circumvention works and why automakers are caught between sanctions compliance and US-European privacy laws. Third, Alphabet's 100-year bond funds, a $185 billion AI buildout, betting on a century of dominance with short-lived hardware. We'll analyse why this massive bet creates stranded asset risks and what it signals for a potentially overheating AI market. Fourth, 7 million Meta AI glasses sold last year, a sales explosion that finally cracks the code for mainstream smart eyewear. In this episode, we'll break down this critical development and what it signals for the future of the wearable AI ecosystem. Fifth, Samsung's HBM4 chip shipment ignites a three-way battle royale with SK Hynix and Micron for the AI memory market. This discussion will reveal how this competition connects to the larger AI chip war and what it means for the future of the hardware supply chain. The most unexpected news in the tech world today has to be this. A single product launch from a Chinese AI startup triggered a global tech sell-off that wiped $593 billion from Nvidia's market value in just one day. That startup was DeepSeek. In early 2025, it upended the entire AI industry by releasing a powerful model that was just as good as top US competitors, but at a fraction of the cost. What's remarkable is that DeepSeek managed to do this despite facing US semiconductor export restrictions. So how did they pull it off? Research suggests they used a combination of brilliant workarounds. One key technique is called model distillation. It's essentially a way to train a new efficient AI by having it learn from the outputs of a larger, more powerful model, sort of like an apprentice learning from a master. This dramatically cuts down on development costs. Additionally, reports from a US House Select Committee indicate they likely acquired restricted Nvidia chips through intermediaries and by renting access to them via cloud services. A new report found that Chinese AI models now operate at roughly 1/6 to 1/4 the cost of comparable American systems. DeepSeek proved you don't need to spend tens of billions to build cutting-edge AI, and the impact is staggering. As a result of this low-cost, high-power approach, Chinese open-source models now account for nearly 30% of global AI usage, fundamentally challenging the market dominance of expensive American systems. But that's not the whole picture. The real turning point is that 1 year later, China's tech giants are launching a full-scale counterattack. Around the Spring Festival holiday, a flurry of new low-cost AI models are set to drop from the biggest names in the country. Now, this timing is no accident. Actually, the Spring Festival has become a strategic launch window for tech companies, allowing them to capture massive consumer attention and leverage the holiday spending surge. It's becoming a predictable annual cycle for AI innovation. Alibaba is preparing to unveil its Qwen 3.5 series. ByteDance just released a video model it claims can produce cinematic blockbusters in seconds, and its Dubiao chatbot is already China's most popular AI app, with over 155 million weekly active users. The strategy here is different from DeepSeek's. These companies are deeply integrating AI into their existing consumer empires. For example, Alibaba is embedding its Qwen AI assistant directly into services like Taobao for shopping and Alipay for payments, creating a seamless, all-in-one user experience. This all represents a massive strategic pivot. Before DeepSeek, many Chinese industry leaders argued for closed proprietary systems, but within days of the startup success, those same rivals began opening up their own models. The combination of open source access and low deployment costs has become the new playbook. While rivals are now focused on integrating AI into consumer services, DeepSeek remains structurally different. Its parent company is a quantitative hedge fund, which allows it to prioritize pure research over commercial pressure. This creates a totally different incentive structure. DeepSeek's parent, a hedge fund named High Flyer, had an incredible 56.6% return in 2025. Those profits provide a steady stream of cash for AI research without the constant pressure for immediate monetization that venture capital-backed companies in the US often face. The AI race is no longer just about who has the most powerful model, it's about who can make it cheapest and most accessible. Chinese companies are now actively embracing open source, significantly lowering the barriers for global developers and enterprises to access cutting-edge AI technology. This shift is forcing everyone, including major US players, to reconsider their entire business model, moving the competition from a battle of technical performance to a war of economic efficiency. Speaking of China's economic maneuvering, another story shows just how creative their global trade networks have become. Tens of thousands of cars from Western and Japanese brands that publicly pledged to exit Russia are still flooding the market. We're talking brand new Toyotas, BMWs, and even Mercedes, all available in Moscow dealerships. The pipeline is a massive grey market operation running directly through China. At the heart of the scheme is a simple yet effective trick. Intermediaries in China are taking brand new zero-mileage cars, registering them as used, and then immediately exporting them to Russia. A former car trader in China said it plainly, this way is to export more easily. This simple reclassification allows them to bypass automaker restrictions and sanctions. Now get this, for Chinese dealers, this isn't just about moving cars, it's about exploiting incentives. By registering a new car as used, they can sometimes qualify for export subsidies and tax benefits designed to boost China's used car market. So they sell the cars at a discount in China's tough market, get government benefits, and then the cars are sold for a huge profit in Russia. These cars are often sold at a discount in China's hyper-competitive market, but fetch full price once they arrive in Russia. The scale of this operation is staggering. Since the 2022 invasion of Ukraine, over 700,000 vehicles from foreign brands in sanctioning countries have been sold in Russia. Last year alone, nearly 30,000 new Toyotas were registered, with almost 24,000 of them coming from China. On the luxury side, nearly 47,000 new vehicles from BMW, Mercedes, and Volkswagen Group hit Russian roads, and over 20,000 of those were made in China. And this pattern isn't limited to cars. We're seeing a similar playbook with other sanctioned goods, like high-tech semiconductors. Research from the American Enterprise Institute found that since the conflict began, roughly 89% of the microchips Russia acquired came from China. So whether it's a luxury car or a critical piece of technology, these grey market routes are proving incredibly difficult to shut down. Automakers like BMW and Mercedes say these grey market imports happen outside our sphere of influence and expressly against our will, noting that investigations are complex and time-consuming. So, a natural question arises. With all this modern tech, why can't automakers just track or disable these cars? Well, they're caught in a legal and technical bind. In Europe, they have to comply with strict privacy laws like GDPR, and in the US, there are state laws like the California Consumer Privacy Act. These laws prevent companies from tracking and using your car's data without your explicit consent. Beyond that, the idea of a remote kill switch is a massive safety and ethical concern. Imagine if that technology fell into the wrong hands or was abused. There's no international standard for this, so automakers are caught between sanctions and privacy laws. But Russian dealers paint a different picture, describing a vast network of middlemen. One dealer admitted, there are lots of middlemen. This one knows that one knows another, and that one can reach the dealer. While Western automakers have officially exited, China has become the primary conduit, keeping the Russian market supplied with foreign cars. The system of reclassifying new cars as used creates a loophole that, as one sanctions expert noted, makes it almost impossible to stop these vehicles from reaching their final destination. This isn't just about bad press. The stakes are incredibly high for the car companies. The US government, for example, has shown it is willing to pursue companies for sanctions violations, even when they happen indirectly through third-party countries. The Departments of Commerce, Treasury, and Justice even issued a joint note reminding non-US companies that they still have to comply with these laws. This creates a huge legal precedent. If automakers can't get this under control, they could face massive fines or even be pressured to pull their manufacturing out of entire countries to avoid the risk. While automakers grapple with geopolitical risks, tech giants are taking on massive financial risks of their own. Google's parent company Alphabet just made a financial move that's turning heads, issuing a 100-year bond That's a bet from investors that the tech giant will still be around to pay its debts in the year 21-24. You know, a century bond like this is incredibly rare for a company. It's usually something reserved for governments. For investors, it's a massive vote of confidence. But for the company, it's a way to lock in today's interest rates for an entire century. They are betting that the cost of borrowing money will be higher in the future. So they're locking in a rate now for the long haul. This century bond is just one piece of a massive $20 billion borrowing spree. The reason for the cash grab is even bigger. Alphabet expects to spend a staggering $185 billion this year, almost all of it to fund a colossal AI infrastructure buildout. A while back, we analysed Oracle's plan to raise billions in debt for the AI gold rush, and it looks like Alphabet is now joining what some are calling the AI hyperscaler debt fest, but on an even grander scale. However, if you zoom out, you'll see a massive contradiction at play. The hardware this $185 billion build-out is paying for might not even last a decade, let alone a century. The pace of AI development is so fast that the powerful GPUs, the graphics processing units that are the brains of AI, have a service life of just 1 to 3 years in a data center. Traditional hardware refresh cycles of 5 to 7 years are being compressed. This decision brings both long-term financial security and comes with the inherent risk of creating stranded assets, billions of dollars of equipment becoming obsolete long before it's paid off. This is the AI arms race in full swing, a high-stakes battle where Alphabet, Amazon, and Microsoft are all scaling up spending to historic levels. While the bond offering attracted huge demand, with orders reaching almost 10 times the amount for sale, some strategists are sounding the alarm. One expert called the levels of debt being raised off the historical scale, warning that the deal is a sign of market froth around AI. His direct quote, "You can't get much more frothy than that." He went on to say that a 100-year corporate bond, even if brilliantly executed, looks like a signal of a top. Interestingly enough, history offers some stark warnings here. The issuance of these ultra-long duration bonds has sometimes been a canary in the coal mine. Think about the railroad crisis of the 1870s, or more recently, the surge in long-term bonds right before the dot-com bubble burst in the late 90s. In both cases, extreme market optimism was followed by a painful crash. So when an expert sees a 100-year bond for a tech company, they're not just seeing a financial instrument, they're seeing a potential historical pattern repeating itself. But the story gets bigger, escalating a trend we've been tracking. Projections now suggest that tech giants could issue a jaw-dropping $3 trillion in total debt over the next 5 years to finance their AI ambitions. We previously discussed how cash-rich giants like Google were seen as safer bets, funding AI from reserves, which contrasted with the riskier debt-fueled path of companies like Oracle. This new move from Alphabet, however, blurs that line and has led one market veteran to draw a sharp contrast between corporate and sovereign debt, cautioning that a company's fortunes can change dramatically. He concludes that the sheer scale of this AI hyperscaler debt fest is a reminder of past market manias, where a theme is followed to the extreme, sometimes without a full grasp of what is actually being bought. So who's on the other side of this bet? A huge portion of the demand for these long-term bonds comes from institutional investors like pension funds. They're looking for stable long-term returns to pay for retirements decades from now. The implication is that if this AI gold rush doesn't pan out as expected, the financial shockwave won't just hit Wall Street. It could affect the retirement plans of millions. We were just talking about the mind-boggling sums being spent on the back end of AI, but now let's shift our focus to the front end, where AI is starting to look a lot more fashionable. The company behind Ray-Ban just dropped a number that is an absolute bombshell for wearable tech, especially since the dream of smart glasses has, until now, been a graveyard of failed tech experiments. Think about it. Google Glass, Snap Spectacles, they all tried and failed to get regular people to wear computers on their faces, often because of clunky design, privacy fears, or just not being very useful. But this might be different. EssilorLuxottica announced it sold over 7 million Meta AI glasses last year. To put that in perspective, that is more than triple the 2 million units the company sold in 2023 and 2024 combined. This isn't a slow burn, it's a sales explosion, signaling that wearable AI devices are finally gaining serious momentum with consumers. What this signals is that Meta has captured a staggering 73% of the entire AI glasses market. They aren't just selling a product, they are dominating a category. They helped create This success is a huge validation for a market that many had written off. The success is being driven by a powerful long-term partnership between the eyewear giant and Meta. They are using iconic, trusted brands like Ray-Ban and Oakley to make people comfortable with putting artificial intelligence on their faces. And this partnership is the secret sauce. It's not just a logo licensing deal. Meta actually made a massive strategic investment of around $3.5 billion for a stake in EssilorLuxottica. This shows a deep, long-term commitment, blending Meta's tech expertise with EssilorLuxottica's century of eyewear design and market power. It's a true fusion of fashion and function, which is where previous tech-only companies failed. The company itself declared its success is helping to propel the AI glasses revolution, with its famous brands being the key driver of demand. This is where the situation takes a more complex turn. After a quiet launch of the first model back in 2021, the technology has advanced significantly. The latest Ray-Ban iteration, which features a small display in the lens and can be controlled by hand gestures, now retails for $799, proving this is a premium market. So, how do those hand gestures actually work? The glasses pair with a wrist-worn device called the Meta Neural Band. The band uses a technology called surface electromyography, or SEMG, which reads the tiny electrical signals your muscles generate when you move your hand or fingers. It translates those muscle signals into digital commands for the glasses. This allows for super subtle, almost invisible gestures to control the interface. We're seeing Meta take this path, while at the same time, Apple's Vision Pro uses a completely different approach with external cameras to track your hand and eye movements. Meta's approach with the neural band is about reading your body's own signals directly without needing a camera to see what you're doing. This surge in adoption has the two companies thinking much bigger. Meta has already extended its partnership with EssilorLuxottica to collaborate well into the next decade. The real end game is becoming clear. Reports now indicate the partners are discussing doubling production to meet the incredible demand, with a potential target of at least 20 million units by the end of this year. But believe it or not, scaling from 7 million to 20 million units is a monumental challenge. This isn't like making traditional sunglasses. They have to source complex, specialized components like high-resolution microdisplays and powerful AI processors. They have to completely re-engineer assembly lines to integrate these sensitive electronics into a fashionable frame. It's a collision of the consumer electronics supply chain and the world of high fashion, and it's incredibly difficult to pull off at that scale. This isn't just a successful product launch, it's a massive bet on a future where smart glasses become mainstream. But as we step into this future, there are some really important questions we need to ask, especially around privacy. For instance, recent policy updates for the glasses revealed that voice recordings are stored by default to help train Meta's AI, and users have to manually go in and delete them. The camera is also enabled for AI use by default. This is a very different approach to data than on their social media apps, where you have more control. So as these devices become more common, the conversation about what data is being collected and how it's being used is going to become more critical than ever. Speaking of the complex components inside these new AI devices, the battle for one of the most critical parts just heated up dramatically. Samsung just fired a massive shot in the global AI chip war. The company announced it has started shipping its most advanced HBM4 chips to customers. Now, for those of you who have been with us for a while, you know we've talked a lot about HBM, or high bandwidth memory. For anyone new, think of it as a skyscraper of memory chips stacked vertically that sit right next to the main AI processor. This design is critical for feeding massive AI models. For a bit of context, Samsung was a bit slow to this party, reportedly struggling with what's called yield rates, the percentage of perfect usable chips. But this announcement signals they believe they've cracked the code on a component we've previously noted was sold out for years to come. This isn't just an upgrade. Samsung is touting a 22% performance increase, delivering a consistent processing speed of 11.7 gigabits per second. It's a direct challenge aimed at narrowing the gap with competitors in the race to supply critical parts for AI accelerators from companies like Nvidia. The key to that speed boost is a fundamental change in the chip's design. The new HBM4 standard doubles the data pathway. Imagine going from a single-lane country road to a two-lane highway. You can move twice as much traffic at once. This wider interface, a 2048-bit interface to be specific, is what allows AI accelerators to process enormous datasets for models like GPT-5 far more efficiently, slashing training times. This is why a company like Nvidia which makes the GPUs that are the engines of the AI world, is so hungry for this technology. Having multiple strong suppliers like Samsung and SK Hynix gives them huge negotiating power and protects them from relying on just one source. Here's where it gets interesting. Just as Samsung makes its move, its chief rivals are making the exact same claim. SK Hynix, the dominant leader in the market, says its HBM4 chips are already in volume production, and they're not backing down, stating they aim to maintain their overwhelming market share. After all, maintaining that lead is incredibly difficult. It's a complex process of stacking up to 12 or even 16 layers of ultra-thin memory dies. The challenge is getting the connections between these layers perfect. Even tiny misalignments can ruin the whole stack. Research shows that achieving a high yield rate, meaning a high percentage of working chips, is the single biggest factor in profitability. SK Hynix is aiming to get its HBM4 yields to the same level as its older HBM3E chips, which is a massive technical challenge, but it's the key to dominating on both price and supply. And it's not just a two-horse race. Micron has also confirmed it is in high volume production and has commenced customer shipments of its own HBM4 chips. The market is reacting instantly. Following the announcement, Samsung shares jumped over 6%, while SK Hynix also saw its stock climb, signaling just how high the stakes are. This isn't just about one company trying to catch up. This is a full-blown three-way battle royale. Samsung, SK, Hynix, and Micron are now all claiming mass production of the same next-generation technology at the same time. The fight to supply the hardware that powers the AI revolution has officially entered a new, far more intense phase. What really brought this to a head, though, is the fact that the arms race is already looking ahead. Samsung is already talking about sampling its next generation chips called HBM4E, which promise to be nearly 2.5 times faster than what's on the market today. This isn't just a battle for today's AI, it's a war for who will control the hardware that powers the AI of tomorrow.
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.